complicated, and that, you know, the client that we're discussing things with, as you'll see from this first page there on financial situation analysis 2, we're talking about where the client could be reliant on their own business, trading performance for their income ability. So what you could find, you know, is they're taking a salary out of the business, or they're taking a dividend out of the business. It depends on the business structure, you know, which you'll see as you progress through some of the other modules. But what we're saying is, you know, as financial planners, it'll be really, really key that you understand about business. And we'll be looking at, you know, some small businesses and some slightly larger ones. I mean, the predominance of business generally right across the Caribbean tends to be quite small businesses, and that's similar in the UK actually. People think the UK, you know, has lots and lots of large businesses. They don't actually. And the last survey undertaken by the Department of Trade and Industry showed that 90% of all businesses in the UK are categorized as small, you know, which is quite a surprising statistic. You know, they employ collectively lots of businesses, lots of people put together. So yes, we do have some big businesses, but not so many. So it's similar, again, within the Caribbean. You know, you have lots of small businesses, you have a few sort of medium size, and then you have a few large businesses. But if you want to write on this first page straight away, we're still doing the same thing, and it's KYC. So, you know, we want to know your customer. So in this financial situation part 2, it's KYC once again. But this time, if you write on that sheet KYC, and then you draw like 2 arrows alongside it, because what we need to know is, in knowing the customer this time, we need to know the management of the business. And then your other line, the other arrow, is to know the business itself, yeah? To try and gain an understanding of the business will be very, very important. So before I take you into some of the narrative that's on that first page there, in terms of the 3 key documents, once again, you know, we'll be looking for the balance sheet. And last week we talked about a personal balance sheet where you list the things you own and you list the things you owe, and hopefully you come up with a personal net worth, where you'll see in business, whether it's small, medium or large, it's exactly the same. You know, it's just the figures and some of the entries are a bit more complicated. So in the business balance sheet, you know, we'll be looking for the assets in the business. Some will be what we call current assets, which are shorter term. Some will be fixed assets, you know, like machinery, buildings, premises, etc. And then, just the same as with the personal client, we'll be looking for the total assets in the business, and then we take away the liabilities, and what we're looking for is that balancing item, you know, which we can call the business net worth. So just to re-emphasize that, last week we were talking about personal net worth. This week, and as we progress with business situations, whether it's small, medium or large, what we're looking for in the balance sheet is the net worth of the business. Everybody okay with that?
Yes.
So conceptually it's the same, it's just, you know, the entries will be a bit different, there'll be more entries, but the principles are exactly the same, and we're looking for a good net worth position, which will give us a buffer between the assets and the liabilities. And then what we're hoping year by year is just the same as in the personal situation, the business net worth will improve. But of course, business isn't as straightforward as that. You know, it's not a textbook exercise. You know, competition changes. Tourism, you just mentioned, is a bit slow at the moment. You know, things change. So year by year, you might not see, you know, the sort of improvement in net worth that you'd be hoping for. You know, it might be a bit more volatile than that. So we have to be prepared for that. Now, the other key document is the income statement. Just the same as we discussed, you know, with the personal clients looking at their income position. But with the income statement, we'll develop a template that will be suitable for any business that you're looking at, with the exception of financial institutions, because their income statement is very different. And then the final document, of course, is, as we discussed briefly last week, will be the cash flow document. Now again, it's the same. You know, when you talk about cash flow, you can look at some very complex definitions. And you know, Moody's many years ago came up with the definition of cash flow of EBITDA, earnings before interest and tax, adding back depreciation and amortization. Why are those back? Because they're non-cash items. But really, the truer definition of cash flow is simply the cash coming into the business less the cash going out. Yeah? So it's as straightforward as that. But actually, when we look at the cash flow and the cash flow analysis, it's quite complicated. But at the end of the day, you know, it's the difference between what cash is coming in and what cash is going out. So, 3 key documents. So on the first page here, what we're talking about is some key assessment areas, which will be things like the client and the business. You know, what type of business are we looking at? Is it small, medium, or large? You know, what sector are they in? Etc., etc., because this will be important for us to get an understanding of the business. Then, what assets does the business have? Are they, you know, utilizing lots of current assets, such as receivables or debtors or stock or inventory? Or is there, you know, a balance of current assets and fixed assets? Or is the business very heavily involved in fixed assets? We need to look at the structure of the balance sheet. Then point number 3 really is very, very key in terms of your work, you know, going forward and becoming certified financial planners. What is the repayment ability of the business in terms of servicing the debt? And if you're talking of investment plans, you know, is the scope, you know, from the business of generating sufficient to repay not only the debt, but to manage some investment schemes as well? And then also, what about the business performance? Are the business people monitoring what they're doing? And quite often in business you find that not much monitoring goes on, because business people generally, you know, they generally like selling the product. They generally like, you know, dealing with people, dealing with customers, and quite often the last thing on their mind, you know, is monitoring the progress of the business. But as this module progresses, and module 2, and the course progresses, you'll see there's quite a number of things we recommend to try and assist the clients keep a hand on how the business is going. So still on the first page, I did a diagram for you there, and you'll see your assessment process as a financial planner, you know, isn't just the top bit. So it's not just the customer, you know, like we're looking at with Edwards or Jane Brown. This time, yes, we're looking at the customer, but we're also looking at the business situation there as well, as we've been discussing. And towards the bottom of the page, what I'm suggesting is these areas need to be studied carefully in order to avoid some of the pitfalls that we've seen going back many years, where financial planning has been too focused, you know, just on the person and not looking at the business in the background. A full assessment should be made to reach a balanced judgment. That's at the top, page 2. Now this next paragraph is very, very important, because again, if the balance sheet looks strong, you know, there's a temptation to think, oh, well, this business will be fine. You know, they can generate money to pay the debt. They can generate money for the investment schemes that we're discussing with them. But it's not necessarily so, because some balance sheets you'll find are strong, but the debt burden has to be serviced, and it can only come from the income earning capability of the business. So I'd underline that, because that's possibly a question that you might get, from the examiner. The debt burden has to be serviced from the income earning capacity of this business. So what we'll be looking at quite a lot is to try and get a good understanding of the trading profile of the business. And this will be displayed in the trading and profit and loss account. And you could write the income statement, because that's what we used to call it, the trading and profit and loss account. Some people still call it profit and loss account, but generally most people now call it the income statement. And if there's any projections, we'll be able to see the profit budget, so that would be a projection of profit, and the cash flow budget. Both of these, we'll take a look at. Now, on the next page, the following details. The cash flow will help us with the business income streams and what's being done with the money, the cash, and how much is required to fund the differences. So if you write there, is the business cash positive or cash negative? And we'll explore this in great depth when we progress through the cash flow, because this is very important. Is the business a cash generator or a cash consumer? Lots of businesses you look at will actually be consuming cash. That's not necessarily a bad thing, as long as the client understands what's going on. So the plans for dividend payments and repayment of any debt will be illustrated in the cash flow, and the feasibility of these will be shown by any margin available in the profit budget. So that's a budget for profit going forward, and looking at what profits these people made in the past, looking at their audited accounts, looking at their management accounts, looking at the draft accounts. And I know, history is not necessarily a guide to the future, but quite generally in business, if we can look at the track record of the business, it's the same as we're doing last week when we were looking for the track record, Mr. Edwards, or the track record of Jane Brown. In business, we're trying to do the same thing. We need to see how the business has been performing in the past, because that will give us some guidance as to what will happen in the future. In financial planning, if you're in discussion with a client and they're showing you their plans for the future, and they've been doing like sales of $100,000, $120,000, $90,000, and then they're in discussion with you, and their plan is to do $500,000 of sales, well, you can see that's a radical change, isn't it? That's something that would need questioning. Or you get a business startup plan to review, and you'll see in this business, within 5 years, this business, the people behind the business are expecting to be listed on the stock market, quoted on the stock exchange in 5 years. So you would have to take a very strong look at that, because that would be extraordinary, wouldn't it? To go from a standing start to a listing in 5 years. Now, I'm not saying some people haven't done it, because some people have, but it's quite a difficult achievement to do. So that leads us on to the technical ability of the client. Now, this is very, very important. If it's a car repair business, a small business, what skills have the mechanics got? If it's plumbing, central heating, it wouldn't be central heating, sorry, in Nassau, it would be air conditioning, do they have the skills to service those units? If they're in building projects, do they have the skills to work to the correct quantity surveyor standards? So these things have got to be done properly, because there'll be no source of income, if they don't have the skills to satisfy their customers or the shareholders if it's a larger business. So once again, we have the integrity of proprietors. And as we discussed last week, it's a lovely word, the integrity of the person. You know, when we're looking at the Campari framework, integrity in business is key. You know, we've had lots of problems recently. Good morning. Within London, and you know, you've read about the recent scandals in London once again, and in Switzerland, and also in the US. So, you know, the integrity of the people we're dealing with will be key. So once again, we're using the words there, KYC, knowing your customers. So here's just some checklist points. How long has the client been known to you? You know, and what's their track record? If you haven't known them before, here's a good question. You know, why is the client coming to you? And, you know, quite often you'll get the most bizarre reasons. Well, I'm coming to you, you know, because I've heard, you know, you're the best financial planner in Nassau, blah, blah, blah. You know, well, that could be very true, that you are. Or are they coming to you because they've had problems either with their previous financial planner or, you know, with their previous financial institution? So when somebody's coming to you that's new, that's very nice, but we need to just be, you know, a little bit more cautious. And if they're coming to you and you haven't known them, bullet point number 3 there, can evidence be shown of an acceptable track record elsewhere? So again, it's doing our homework, yeah?
Yeah.
You know, lots of financial planning is about doing your homework, you know, trying to figure out what's going on, where have these people been, you know, what are they going to be doing now, what's their business experience, especially in the area of trade they're talking to you about. And I would think again about business startups, you know, where people are going into business, do they have any experience in that type of business? Or is it just, you know, like a wacky idea that they've been discussing, you know, in the bar one night over a couple of beers, yeah? You know how men go, don't you? Oh, that sounds a great idea. You know, we'll go into the bank, or we'll go to see some financial planners tomorrow to discuss our new business idea, you know, that's going to make us $1 million. You know, what experience have they had in that trade? You know, if they're running a sandwich bar, and they're going to go into a small type of restaurant, well, you know, it is slightly related, but there's a lot more to managing, you know, a restaurant in terms of the customer profiling, etc., than the sandwich bar. Or worse still, you know, they've been running a sandwich bar and they're going to start to run a 4-star hotel. Big quantum leap, yeah? Now the next point is where we have to be very careful. In the UK, you know, in Europe, definitely, in the USA, definitely, but within your jurisdiction, very, very important, you know, where has their personal net worth come from if they've got accumulated net worth. You know, we're talking about all the old things that we need to be careful of. It's just the same in the UK, and I always find it very sad, you know, when the USA targets, once again, the Caribbean, you know, talking about financial risks, risky institutions, etc., because there's plenty of risky institutions out there, you know, within the US and within Europe. And look what happened recently with one of the biggest banks in the world, Hong Kong Shanghai Banking Corporation, yeah? You know, they're being investigated for potential money laundering issues. So, you know, it's not just happening in the Caribbean, it happens everywhere. Next point, what is the personal commitment to the business? This is very important. They're coming to talk to you about their business plan. They're talking about maybe getting a loan from the bank, $1 million loan. How much have they got in? $100 capital. It's nonsense, isn't it? You know, what's their commitment to the business? Because in a business like that, you know, we're going to be taking all the risk. If it's a company, are they prepared to give personal guarantees towards the company? Now you have to be careful here, because a guarantee is commitment, but a guarantee. So we have to be careful. A guarantee is a commitment, but it's not a substitute for actual cash coming in to strengthen the balance sheet. And then finally, does the client have adequate life and health cover? Now the next important point starts on the top of the next page. And this, I would write against this business visit or site visit. Now this is very, very important, you know, in your job, that if it's a business you're dealing with, please try and get out there and see the business. If you can't go, you know, there should be someone within your organization that goes to see the business, because seeing it, you know, will build up the picture of what's going on. You know, we'll see the size of the business, and it will give us a lot of information. Most business people I've visited are willing to show you around. You know, they like to show you around. Observation and discussion will help you make a judgment as to their technical and management ability. So what's their experience? How long have they been in business? Are they using modern techniques? You could write there, or old techniques. There's nothing wrong with old techniques, you know, provided they're working satisfactorily. The next point's important. Are they in control of the business, or do they spend a lot of time away, you know, and somebody else is managing the business? If someone else is managing the business, do they have the skills and ability to help effectively? Are there any routine tasks in the business that should be delegated? And who keeps the business records? Key point for you, I'd underline that final point. Who keeps the business records? These people are key. So we're going to chat with the directors of the business. You know, they're telling us everything's going along fine. But then we need to see who's keeping the business records, are they up to date? And let's see what's going on. So you also learn about the business size, you learn about the products, the state of the buildings and machinery. When I think about machinery, I always have a case comes immediately to mind. I visited this factory, and in the balance sheet, the machinery in the balance sheet was $250,000. It stuck right in my mind because I thought, well, that's a big figure for the value of the machinery. And when I got there, I made a point of going to look at the machinery in the factory. I couldn't believe it. This machine, it was only one machine, by the way. This machine was old, really old. It had lots of rust on it. You know, and I said to the directors of the business, I said, how can you value this at $250,000 in the balance sheet? You know, they argued that it was worth that, but I was very skeptical about that. Good morning to people just coming in. And then the other point is, if I talk to you about, you know, increasing sales, increasing production, you know, does the machinery that's there have the capacity to meet production plans? And I'd write alongside that paragraph, over-trading, question mark. Because you'll find there's a lot in business where the people tend to try and overtrade. Overtrading by definition is growing faster than your business resources. So overtrading is growing faster than business resources. And the business resources can be the capital in the business. So you could be trying to grow too fast for the capital and reserves that's in the business, or it could be the people as a resource, or it could be the machinery, you know, or it could be the plant and the equipment. So these things are important. Everybody okay so far?
Yes.
So we're just taking our way, you know, quite gently, talking about some of the background. You can see all these things we've been discussing come back to those three words once again, you know, KYC, know your customer. Your job as a financial planner, you're never going to get anywhere unless you know your customer. And that's not just as an individual, it's knowing the customer's business, you know, if the business situation is involved in what we're looking at. Now, to help us with this, our starting point is to look at the financial performance. And you'll see I've got there understanding the accounts and a couple of question marks. Not question marks, exclamation marks. Because this part is very, very important. Now, generally people like yourselves, quite generally, people like myself, I'm not an accountant, but you know, one of the things we have to understand is sufficient about the accounts that we're being presented with to understand what's happening with the business. Now, I'm not an accountant, so I don't, understand the basic of how the bookkeeping entries get generated into so-and-so, yeah? I don't need to know that. If you have the misfortune to go to the hospital for an operation, the surgeon who's going to make the operation doesn't need to know how the scalpel is put together, does he? All he needs to know is how to use this tool effectively. So that's the medical analogy. It's the same with you as financial planners. We don't need to know how these things are put together, but what we need to understand is what they mean, what they tell us, and an understanding of the business. So what we're going to get is a huge variety of the standard of the accounts. So you'll see I put that in italics. I would suggest you underline this. The standard of accounts can vary widely. The important thing, therefore, is to try to get an understanding of the true financial position of the business and the cash generating ability to cover any proposed debt or any proposed dividend. So that's what we need to get to. Now, if you have the bank records of the business, well, you're off to a flying start, because it's back to what we discussed this week, behavior of the person. How is Mr. Edwards behaving? How is Jane Brown behaving? How is the business person behaving in terms of the management of their bank account? So again, this will help us in establishing the track record of the business. What's the business turnover going through the bank account? I mean by business turnover, I mean the activity of the payments coming in and the activity of payments going out. There should be a correlation between the activity in the business and the sales figure in the annual reported accounts. If there isn't, be careful, because there could be some funny business going on, yes? Again, we had an example of this, where the activity through the branch manager, this was a group of car outlets, car dealers, car sales, yeah? And the bank manager was reporting a huge amount of activity going through the bank accounts, and yet when we saw the financial statements, the actual sales through the financial statements were much, much, much less. So we started to ask the questions why, and in the end we found out why. We discovered that these business customers of ours, not only did they bank with us, but they banked with about 3 or 4 other banks as well, where they were diverting some of the sales in there. So it's important to look at the activity through the accounts. Now, what we do for this is some key ratio analysis. Now, some of you will have done some business ratios before, so you'll have an idea about this. In terms of financial planning, we're going to focus on a certain number of key ratios. Some of these you might have seen before, some you might be using in your financial institution, some you might not. But for the purpose, of this program, these are the ratios and the expectation when we do the cash flow. These will be the ratios on which your mock exam will be based. And also, I firmly believe the ratios that we'll be using are enough to give you an understanding of the business and how it's performing. So what we'll do is I'll take you quickly through these ratios, and then to bring it to life, we'll look at the case study, and I'll get you to work some ratios, working with the person next to you, or 2 people next to you, And we'll do a case study and work these business ratios, and then we'll see what these ratios tell us. How is the business performing? So ratio number one is sales growth. I like to start with sales because every business person I've ever met, they might not know anything about their working capital and their business ratios, but usually most people in business know about their sales, don't they? So it's a good starting point for conversation. Oh, how are sales doing this year, compared with last year? And then we can quantify it. Sales in this year less last year, divided by last year will give us sales growth. Very, very important. If you do this and sales have grown by 10%, you then need to test this against what you would expect of businesses in that particular sector. If you know the tourism sector, for example, has grown by 20%, and your client's only grown by 10, you'd be wondering why. Or, if the sector you're looking at actually declined, and your clients improved, well, that's good news, isn't it? Yes, so we need to try and benchmark this. If it's grown this year by 10%, and last year it grew by 20%, well, growing by 10 is good news, but 10 compared with 20 is not such good news. So it gets us off to a good start, and it gets us off to a point of good discussion, because people generally, like to talk about the sales. Next ratio is very, very, very important. The gross profit margin. So the gross profit will be the difference between the sale and the cost of sale. And if you want to write just to the left-hand side there against number 2, if you put cost of sale equals, and there's a formula for this which you should memorize. There won't be many formulas I ask you to memorize, but this is one. Cost of sales or cost of goods sold equals opening stock plus purchases minus closing stock. This is very, very important, as we'll see as we progress during the module.
Can you repeat that?
Opening stock plus purchases less closing stock. So to arrive at the gross profit, as we'll see in a few moments, we'll take the sales and then we'll deduct the cost of sales. Some people call it cost of goods sold, and that will give us the gross profit. Then what we do is we divide the gross profit figure by sales and multiply by 100, and that will give us the gross profit percentage. This is a key business ratio, very, very important. Now if you went down Bay Street, we went into John Bull or whatever, and we looked at their gross profit margin, anyone, any idea whatsoever of what sort of gross profit you might expect from that shop?
40%?
Yeah, very good. In a retail operation such as that, generally, lots of retailers, with the exception of food stores, right? We're not talking about food stores. Generally, retailing clothes, retailing fashion items, etc. Generally, retailing, they'll be buying the goods in and they'll be marking them up quite significantly. So, for example, if it's a clothes store in Bay Street, the chances are they're buying in the clothes already made. If they're buying them in for $20, the target would be to try and double the price, to try and sell it for $40. So what gross profit would that achieve? If you sell for $40 and you bought in for $20, what's the gross profit?
10%.
Sorry?
10%.
No. Be careful. So write that down. $40 sale minus $20 cost of sale gives us $20 gross profit, yes? Now looking formula number 2, gross profit profit is 20, divided by the sale of 40, multiplied by 100 gives you 50%, yes?
Yeah.
Now that's why you've got to be very careful, because there's always lots of confusion between the markup, and you see the markup is 100%, but the gross profit's 50%. So the idea is here, we could call that ratio what the Americans often call it contribution margin. Well, I quite like that term. Most people call it gross profit, but some people call it contribution margin, because can you see we've got a contribution margin of 50% towards the remaining costs of the business, which would be things like the rent of the shop if it's rented, the wages of the people working there, utility costs, etc., etc. So you can see why that margin is very important. If the business we're dealing with is an importer of goods, so they're importing the goods and then they're selling them to retailers to sell on to people like yourselves, what sort of gross profit margin do you think they would get? Do you think it would be as big as 40% or less? It'll be a lot less generally, because the wholesaler will be working on volume, trying to get large volume, and the margin will be small. Why? Because they're not selling direct to you. Generally they're selling to the stores, who are then selling on to you. So the margin in the wholesaler could be 10% or less. All right? So these are some of the parameters that you build up with experience. Next ratio, look, is operating profit. Very important. Operating profit, you need to memorize. This is the second thing you need to memorize. Operating profit is the profit before interest and tax, PBIT. Profit before interest and tax. You can write alongside that EBIT, earnings before interest and tax. If you're in discussion with an American client, or you're looking at US-based financial statements, it won't say PBIT, it will say EBIT, same thing. Now again, this is a very important ratio. If we take that figure, divide it by sales, it will give us the operating profit margin. So this will be very, very important, because this is further down the statement, as you will see when we do the example. And then coming down further still, we've got the profit before tax divided by sales. So all those ratios there go back to the sales. So they're what I would like to call profitability ratios. If we just jump forward for a moment, a few pages, you'll see where this is leading us to. Can you see the summary ratio sheet? It's quite a bit further on, after the case study. There we are. This is on page 14 on my handout. Everybody see where we're going to be heading? So what we're talking about so far are the ratios that will fit in that top section there, yes? Everybody got that?
Yes.
So if you can, try and keep an eye on that sheet as we're going through these various ratios. So let's go back to where we were. So that first one you can think of as profitability ratios, because they all come from the income statement. Now the next ratios, some come from the balance sheet, some come from balance sheet items linking to the income statement. The first one, look, is working capital. So working capital by textbook definition, accountancy definition, is current assets minus current liabilities, and we'll get both those figures from the balance sheet. And traditionally, we would hope for the current assets to be more than the current liabilities, on the basis that if the business stopped trading, what we would like to see is the current assets extinguishing the current liabilities. Same with ratio number 2. The current ratio are the same two figures, but this time it's one. Now, if you want to write alongside that, historically, we would look for a benchmark of 2 to 3 times coverage. But I'm afraid in today's modern world that doesn't work. You know, quite often we have to manage with a 1-to-1 ratio. And sometimes, in fact, you'll see the ratio is actually less than 1-to-1, and the business still operates satisfactorily. So this ratio is important. It was still calculated. And number 3, the quick ratio, is where people used to call this the asset test. This is where we take the same current assets, but we deduct the slowest moving asset, which is stock. We still work these ratios, but be careful, because these are old-fashioned ratios in a modern world, right? So we're still going to do these because we don't throw these away, but we have to be careful, as we'll see as we progress. Now 5, 6, and 7, sorry, 4, 5, and 6, you should asterisk because these have a huge impact on the business cash flow. Credit given in days. There's ratio number 4, everybody see that? That's debtors divided by sales times 365. Some people call this receivables. Some people call it debtors. These are the people who owe money to the business, yeah? When they're collected in, it will generate positive cash flow to the business, but until the business is paid, the business will need cash flow to finance these receivables. So this is a key effect on cash flow. The quicker these receivables can be collected in, the better will be the impact on the cash flow, which is why I want you to highlight number 4. Number 5, how quickly the stock is being turned over. Now this time generally we don't divide stock by sales, although some financial institutions do. Most institutions, and for your purposes, we divide stock by cost of goods sold and multiplied by 365 days. Be careful with this 365. Anyone in the room there use 360 days?
Yeah.
Yes? Why do you use 360?
The US dollar.
Yeah. The US methodology is 360 days because they simplify their accounting periods into 12 months and 30 days. The rest of the world, with the exception of the Middle East, lots of Middle East analysts use 360 days, but most of the world uses 365 days. And when I did 2 programs in New York with American bankers, I teased them a bit because I asked them, well, why do you guys use 360 when everybody knows right across the world there's 365 days in the year? So why do you use 360? You know what they said? Oh, we've always done it that way. So I made another joke. I said, well, you've only got a history in America of about 180 years. The rest of the world got thousands of years. So why don't you use 365? But of course, they don't because, you know, they have their own accounting conventions. Now, it's important this because, you know, if you're dealing with a US investor as a wealth manager or financial planner, and you've made a few numbers, you've made a few calculations, you know, you could get differences. So just be prepared, you know, that we need to ask, well, how have these figures been calculated? Number 6 is credit taken in days. Another very, very important ratio, because again, this will have significant impact on the cash flow. What's the trade creditors divided by the cost of goods sold? So this gives us the creditor payment period or payables on hand. When we do this on an example, you know, it'll come to life. Asset efficiency is a ratio not many people use, but I tried to talk about it because it's a wide measure of how efficiently the business's person is using all the assets, so it's sales divided by all the assets in the balance sheet. So we will do this. Interest cover, this is looking at the net operating profit, which is PBIT, profit before interest and tax, divided by the interest, and it should give us some comfort as to how well the business is covering their interest. A bit later, when we talk about cash flow, we'll look at cash flow interest cover. So we'll have two interest cover formulas. This is the one that's most frequently used, interest cover from the income statement. Leverage is the total liabilities, and then you have to move to the top of the next page. All the liabilities divided by the net worth will give us the leverage position. We'll calculate this in a few moments. And then gearing, number 3 there. Can you see I've put the total interest-bearing debt divided by the net worth. You can write against this debt to equity ratio. Some people call this the debt equity ratio. Some people call it the gearing ratio. Not to be confused with the leverage, which is the wider measurement, okay? Right, so what we're going to do now is look at the case study, which is the clothing importer. And how we're going to start this off is by doing some mathematics. So if you look at page 12, I hope in your packs you have 3 years balance sheets. Yep. Then you've got 3 years income statements. And then you've got the summary ratio sheet. We'll be looking at the cash flows later. Okay, so here I've been talking nearly an hour now. So here's where you can get into action. What I want you to do is working with the person next to you, or 2 people next to you, however you're seated there, is have a go at this ratio sheet. Don't worry about starting to make comments. You know, we'll look at the comment section later. So the first sort of 15 minutes or so is some number crunching. So if you've got a calculator, that'll help. If not, you'll be using your phone or computer if you've got one with you, or if not, doing some pretty slick mental arithmetic. So let's start this. I'll do the first ratio with you. So sales growth in year 1, where do we get this from? So this is where it's good if you're working with somebody next to you, because somebody next to you can have these definitions handy, other calculations. So sales growth in year 1 we can't do because we don't have the previous year. Yep. So on your summary ratio sheet, sales growth in year 1 will be a line, dash, or not applicable, yeah? Then sales in year 2, yes, you can calculate that, because sales in year 2, sales growth in year 2 will be sales in year 2 minus sales in year 1 divided by sales in year 1 divided by 100. So let's have a go at that together. So from the income statement, we've got sales in year 2, look, of $1,050,000, so 1050 minus sales in year 1's 900,000 divided by 900 times 100, I get 16.7%. Anyone confirm that?
Yes.
Good. So sales in year 2. So with these percentages, generally what we do is we'll take it to 1 decimal point. When we're working on days and stuff, we just take it to the nearest day. Yeah, we don't work in points of days. So can I leave you to have a go with that? Yeah? So we'll try and work with the person next to you there, help each other. Have a go at completing this chart. Shout out if you get stuck, okay? So I'll stop talking, but I'll listen. I'll mute the microphone. And talk to each other, help each other. This is the first time for some of you that you've done this. So we're trying to complete that ratio chart. Should take you about 15 minutes or so. Sorry, I cut myself off, sorry.
That's okay, you can do it anytime.
Can you hear okay?
Yeah.
Yeah. Okay, so some mathematics to get you going.
You gonna come up, right?
The first time he did it, next time he just disappeared.
There we go.
Yes, yes, we can hear you. Just did it.
Share the screen again.
Okay.
Is it sharing up now?
Yep. Good to go.
Okay, thanks. I'll just 5 minutes while you're making some mathematics. Look at the tea.
That's it. Trade data divided by sales times 365. sales figure.
Hey, how you doing?
Hello again. Okay, how are you getting on?
Slowly.
Anyone finished?
Was het jaar gelopen? Zo door?
No, that's
No,
ratio.
wait,
Ratios?
ratios, Miguel. So I'll just check some figures with you for the first year, and you can continue. So sales growth year one, we said we couldn't calculate it because we didn't have the previous year. Gross profit, 10%?
Yes.
Yeah. Operating profit is the, remember we memorized that, PBIT from the income statement. 33,000 divided by the sales of 900,000. I make it 3.7%. Yeah? 3.7%, good. Help each other, you know, with this, because it's not easy to do first time. Then the next line we've got is the profit before tax. So that's $25,000 in year one, divided by 900,000. 2.8%?
Yeah.
Yeah? Well, it's close to 3, but it's 2.8. And then the bottom line, which is very important, the net profit. And this is Miguel's favorite. He loves the bottom line. So Miguel, how do we do the net profit margin?
Oh, I forgot.
Net profit divided by sales, yeah? Well, I don't get that. Be careful here. Be careful with the decimal point. Let's look at this one together. So net profit is $17,000, yeah? And be careful with the zeros. So $17,000 divided by 900,000 for sales, and then multiplied by 100. 1.9%, yeah? So just stopping for a second at that point, what we're seeing as financial planners is this business we're looking at, and it's quite useful to talk to people in terms of $100 of sales because they can visualize it better. So if we said to this customer, to realize in year one, for every $100 of sales of clothing, you're generating $10, yeah? $10 gross profit towards your overhead costs. But the bad news in terms of the net profit is it's only $1.90. Did we see that?
Yeah.
So the bottom line position looks very tight. Okay, let's keep going on the other ones. So working capital comes from the balance sheet, and the accountant's done this for us. It's current assets minus current liabilities. So it's $285,000 minus $250,000, $35,000. And then the current ratio is those two figures, but this time one divided by the other, and I make that 1.14 to 1.
Yeah.
And then the quick ratio is the current assets, but deduct the stock, so we get 150,000 this time. Divided by current liabilities, 250,000. I get 0.6, is that right?
Yeah.
Yeah, thank you. 0.6 to 1. Everybody okay so far?
Yes.
Good? Yeah, the quick ratio is the current assets, deduct the stock, because it's generally the slowest moving of the current assets. And then you divide it by current liabilities. So from the balance sheet, page 12, we've got current assets of $285,000. If we deduct the stock at 135, we get $150,000 of quick assets, and we divide it by current liabilities, $250,000, so we get 0.6 to 1. Okay, now we're coming to those three very important ratios that I said have a significant impact on the cash flow. That's debtor days, stock days, and creditor days. So let me just check the debtor days with you. So debtors from the balance sheet.
We ain't reached that part yet.
Yeah, I reached that yet.
We didn't reach that
Yeah,
part.
pretty sure, yeah, okay. You must be using Chinese-made calculators.
Bye.
There you go. Yeah, so I'll let you have a go at those sections now. So these are very important figures. Then multiplied by 365. And this time, don't do it to the decimal point, do it to the nearest day. 61 days. Yeah, 60.8, 61. 61 days. I'm just looking at that, I just did the credited days by mistake. So you had stock divided by cost of goods sold. So stock 135,000. Divided by cost of goods sold. 610,000. Times 365. Yeah, by coincidence, it's the same. It's 61 days for the stock. And the next one's the creditors, trade creditors and payables. Be careful here, it's creditors divided by cost of goods sold. I'll make that 63.
The trade creditors.
Yeah, trade creditors.
61 and trade, 61. Total on average.
Everybody got that, 63?
Yeah.
Yeah. So creditors from the balance sheet, $140,000. Divided this time by cost of goods sold. On the income statement, 810,000. Then multiply by 365. I'm hoping you're going to get 63 days. Good. Yeah, help each other if, you know, some of you are stuck. Yeah, now the next one is, if everybody's got that one, has everybody got creditors 63?
Yes.
Okay, now the next one, asset efficiency, that's how efficient is the business at turning over all the assets relative to sales. Now we know the sales figure is $900,000, but we don't know the total assets, so we have to go into the balance sheet. So write that down. Then in year one, if you go further down the page, you'll see the fixed assets of $51,000. So don't forget, total assets in the balance sheet will be the current assets plus the long-term assets. That'll give us all the assets. So if we add 285,000 to 51,000, we get total assets of $336,000. What we're going to do is divide that figure into the sales of $900,000. So we're looking at how many times all of the assets are turned over relative to sales. So it's 900,000 in the calculator, divided by 336,000. And I get 2.68. Yeah, 2.678, yeah, so say 2.7 times. So if we're rounding it up, 2.7 times.
Could you explain how you got that one more time?
Yeah, so what we need is, the formula is sales divided by total assets, yeah? You see the formula there, sales divided by total assets?
Yeah.
So you know the sales figure is $900,000 from the income statement, but what you don't know is total assets. So you need to go into the balance sheet on page 12, and at the top you'll see year one total current assets of $285,000, but you're going to need to add on to that the fixed assets, which are further down. Can you see there's the fixed assets strip? $51,000. So 285,000 plus 51,000 gives us 336,000 total assets in the balance sheet. So that's the figure that you're going to divide into the $900,000. So in the calculator you put $900,000 divided by $336,000, and you should get approximately 2.7 times. So what that means is this particular business, they've turned over all the assets 2.7 times to almost 3 times in the year relative to their sales. We'll discuss a bit more what that means a bit later. So everybody got that, 2.7? Good. Okay, so we're heading into the last section now. Now the return on equity, we leave that for the moment, and we're going to go for interest cover. So interest cover, you remember, is PBIT, the operating profit, divided by the interest. So if we go into the income statement, we'll see there's the operating profit in the first year, $33,000. And we're going to divide that by the interest charge of $8,000. And I get 4.1 approximately. So what that's telling us is the bank's interest charge is covered 4.1 times by the operating profit, which is quite significant actually. You know, that's quite a strong interest cover. Lots of businesses you will look at, the figure will be less than that. 4 times covered is pretty good. Everybody got that?
Yeah. Yes.
So from the income statement, we're looking for the operating profit, which is profit before interest and tax, or the American system would be EBIT, earnings before interest and tax. So the same figure, but the American analyst would call it the EBIT, $33,000 divided by the interest of 8,000 gives you interest cover 4.1. Okay, back to the ratio sheet. Now leverage is a bit tricky. Now leverage is a bit different between the US methodology and the international methodology, but we'll be focusing on the international definition, which is all of the liabilities divided by the net worth. So let's do this one together. So what we're looking for is the total liability. So this will be from the balance sheet again. So from the balance sheet, look, you've got current liabilities. Everybody see that? $250,000?
Yeah.
And then if you go further down, you see there's some long-term liabilities of $6,000. So the total liabilities will be $256,000. And we're going to divide that by the net worth of the business. Now, this is where quite often people get confused because when you look at a sole trader, or when you look at a partnership, or when you look at a small limited company, which this is, or when you look at a larger business, quite often the net worth is a little bit hard to pinpoint because it has different entries in. Now my advice to you is, if you're not sure, just do this simple exercise. You know, in the balance sheet, if we did it in the old-fashioned way, just the same as I had you doing a personal balance sheet where you add all the assets together, add all the liabilities, and take the liabilities away from all the assets, we get a balancing item which we call a net worth, yeah? Personal net worth. Now in business, if you do the same thing, no matter how big or how small the business is, we can then be sure what the net worth figure is. So if we just do that together in year one. So in year one, you remember, we had current assets of 285,000, and we had fixed assets of 51,000. So if you imagine the total assets on the right-hand side of our balance sheet, at the bottom would be $336,000, yes?
Yeah.
And you've just worked out what the total liabilities are. They were the current liabilities plus the long-term liabilities, 256,000.
Yeah.
So if we take all those liabilities away from all of the assets, we'll get a balancing figure of $80,000, yes?
Yes.
And it's positive, so we know the business has a positive net worth of $80,000. So if we go back to the balance sheet, there we are, look. Shareholders' funds, it's called in this particular case, $80,000. So can everybody see? But if you're not sure, you might be thinking, oh, the net worth could be the share capital of 20. Or some of the people might be thinking, well, I'm not sure about the profit and loss account. So if you do it this way, you know the net worth for this business is $80,000. So back to leverage calculation. The leverage calculation was all of the liabilities, which was $256,000. Yeah, divided by the net worth of $80,000. And I get 3.2.
Yeah.
Let's try that. Everybody okay with that?
Yes.
Great. Now, you could put, for this figure on your ratio sheet, you could put 3.2 for leverage, 3.2 to 1, yeah? But what I like to do, as you'll see with leverage and with gearing, is some banks do this and some don't. I like to express it as a percentage. So I'm going to multiply by my leverage by 100 to give me leverage of 320%, which I'm going to write on my ratio sheet. Now the reason I do this is because when you're in conversation with the business people, if you imagine the business person there in Nassau, you make these calculations and you say to the business person, oh, well, you're covering your interest cost of the bank approximately 4 times. I mean, they'll understand that pretty well. But then if you say, oh, when your balance sheet's leveraged 3.2 to 1, it's hard for them to understand what that represents. But if you say, oh, your leverage in your balance sheet, you're quite highly leveraged because it's 320%, would you agree with me that that's easier for them to understand?
Yes, agreed.
Because mentally you have a picture, anything like over 100%, I think in our minds, we immediately think, oh, well, that's quite high, don't we? So that's why I put it as a percentage. So 320% leveraged. Now let's do the gearing. Now the gearing, some people call this the debt equity ratio. And in the formulas there, I've given you quite a long-winded definition. Now I've done this deliberately because it gives us the way this is calculated. So if you look at the gearing ratio, which is on page, whatever, page 9, am I talking about? Can you see the calculation I put there as the total interest-bearing debt divided by the net worth? Now I could have just written debt divided by equity, but the problem is categorizing what is actually debt. So what I put was the total interest-bearing debt divided by the net worth. So what that means is if we go through the balance sheet, looking at what we think is the debt in the balance sheet, then we ask ourselves the question, does this debt bear an interest cost? And if the answer is yes, we put it into this numerator, yeah? So let's do that together so we're really clear on what's going to go in. So if we go to the balance sheet, and we're looking at the debt in the balance sheet, which is basically the liabilities in the balance sheet. So if we look at the balance sheet together, creditors $140,000. Are they debt? Do they carry an interest charge or not?
Yes, they do.
No, they don't generally charge interest, the supplier credit, unless they're in breach of the supplier agreements. So in terms of the debt-equity ratio, in terms of the gearing ratio, this figure does not go in. So we don't put that in. Hire purchase, which is installment finance, $2,000, would they charge interest?
Yes.
Yes, definitely. So take the 2,000, because that's going to go into our calculation. The bank, look, $90,000. Of course, the bank charges interest. So the 90 is going to go in as interest-bearing debt. So take the 90. Tax, generally no, unless again they're in penalty. And directors' loans, we'd have to make inquiry, are these loans made by the director into the company? Are they charging interest, yes or no? For this, well, for the sake of this calculation, can you see how steady it is at $10,000? So really, it's kind of like quasi-capital that they're putting into the business, and in this particular case, they're not charging interest. If they were, we'd put it in the calculation. So don't take the 10. So far, all we've got is hire purchase at $2,000 and the bank at $90,000. But we have to look at the longer-term liabilities. Yes, there we are, look. Long-term installment financing, $6,000. Yes, they would charge interest. So I'm going to add that in. So I've got 2,000 plus 90,000 plus 6,000. I've got $98,000 to go into my gearing calculation as the numerator, yeah? Everybody okay with that? So can you see what we did? Instead of taking a guess, we worked from the balance sheet, we looked at the items, and we're putting in the interest-bearing items at $98,000. Then we're going to divide that by the net worth, which we know from before is $80,000. And again, I get 1.23, so 1.2 to 1. But again, to make it more significant for discussion purposes, I would say it's 123% geared. Because in my calculator, I've got 1.225. And if I round that up, it's like 1.23. And if I multiply by 100, I get 123% gearing. Which again is more than 100%. So it's quite highly geared. So $2,000, which was the installment financing, $90,000 is the bank, and then $6,000, which is the longer term financing. So we've got $98,000 of debt divided by a net worth of $80,000, and we get 1.225 or 1.23. and then we're going to multiply it by 100 to make it better for compensation. We can say this client, look, your balance sheet's quite highly leveraged, you've got 320% of leverage, and actually in terms of the debt, you know, that you owe, your gearing is 123%, so that's quite high as well. Everybody okay so far? Now we're going to talk in more depth about what these mean when you've calculated the other 2 years. Has anyone been doing the other 2 years? Not yet.
Some of it.
Some of it. Okay, so what we need to do then is concentrate, so take you 10 minutes or so, maybe 15 minutes, to get these get year 2 and year 3 extracted, and then we'll check, you know, we're all on the same hymn page in the book. We've all got the same answers before we can decide, you know, what sort of things is this telling us about this business. So I'll leave you quiet, work with your neighbour, work with your buddy, help each other to fill in years 2 and 3. I know this is quite a lot of answers, but it will be very important, as you'll see.
Don't be shy. Don't be shy, man. Being 45 on the
Get everything out of that.
Okay, let's check a few of these through, yeah? The people who haven't quite finished can finish them before we meet next week, yeah? So when you go back to work on Monday morning, you've got nothing to do. Close the door. Put a sign in, sorry, doing maths. Still maths. Yeah, I know it's a bit of a chore, this bit, but it's worth doing because it helps you understand where the figures are coming from. And then as we discuss this case in more detail, when we meet again next week, we can see what's the trends, what's happening with the business. Because when you look at the front page of the case study, you'll see at the bottom of the first page, the customer's saying that the business is expanding, sales of 1.3 million. And he wants to discuss with you future investment plans. How would you respond to this client? Include an analysis of the business performance. So that's what we're doing at the moment. Before we can do any of the tasks, we need to analyze how the business is been performing. So just as a final 5 minutes for today, let's have a look at some of the figures you got. So what did you get for sales growth in year 3?
23.8.
No, he said yes, 3 years, 23.8.
So
23.8.
Yeah. About 24%, is it?
Yes, 24.
That's good. Okay, now the gross profit was 10%, and then it slipped to 9%?
Yeah.
And then year 3, it went down even further to 7%. Operating profit, 3.7. You'll have to shout the next two out because I didn't get those done.
3.3 and 1%.
Okay, thank you. And then the profit before tax, we had 2.8%. And then I had 1.5%.
1.5. 2.5 and 0.15.
Yeah, now that's the serious thing, isn't it? And you have to be really sure of where your pointers and what your decimal points are, because we're saying 0.15%.
Right.
So what does that mean in terms of profits in year 3? For every $100 of sales, how much profit was he making?
2 cents. 2 cents.
Yeah, not
1.5 cents.
now I have to be careful here. Is it 15 cents?
No, 2
Or is it
cents.
just under 2 cents?
1.5 cents.
Yeah, we have to be very careful where the zero is. So check the zero very carefully. So net profit, because you're going to be really smart with the client if you got the maths right, but really stupid if you got the maths wrong. So let's have a look. He made $2,000 net profit on sales of over $1 million, yeah? So let's put on the calculator carefully. So 2000 divided by 1300000. And then multiply that answer by 100. And what do you get? Is it 0.015 or is it 0.15? Right, good. But you can see it's a drastic fall in performance, so profitability doesn't look good. So you'll see, at the end of the ratio sheet, there's a column there for comments. Well, we can complete that when we meet next week, but you can think about this before we meet next week, what sort of trends are we seeing here? Then we've got the working capital, current ratio and quick ratio. which don't tell us things of much significance really, because they're quite old-fashioned ratios. But the more important ones are the debtor days. Let's look at debtor days. So we had 61 days to collect in his receivables. What about the next year? 59?
Yeah.
Which is slightly better, slightly quicker, and then next year it slips out to 65. Yeah? Stock turnover, very important ratio. When you think, you know, he's in clothing, what's the stock turnover? 61 days, that's about 2 months. Then it gets worse, 73 days.
73.
And then you get 85? 78. Okay. Okay, I'll check my maths here. Then the creditors, that's how quickly he's paying his suppliers. 63, 69,
And then 85.
and 85. Yeah. Yeah, it's creditors divided by the cost of goods sold. You have to be careful, divided by sales. So you can see it's taking him longer to pay his suppliers, yes?
Yeah.
Yeah. Creditors divided by cost of goods sold. So creditors divided by cost of goods sold. And then interest cover, it's getting worse, 4.1, then 4 times, and then it drops to only 1.2. Yeah?
Correct.
Leverage, so that's his leverage in the balance sheet. We had 320%, and I get 325, and 451. Do you get that?
Yes.
Yeah? So leverage has got much worse. And gearing, so that's the debt to the equity, gearing 123%. Then I made it improve slightly to 117.
Yeah.
Did you get that?
117?
Yeah?
Uh-huh.
Anybody get that or not?
Yes.
And then next year it slips to 150%.
Yeah.
Correct.
All right?
Correct.
Okay. So what I'd like you to do then is you work hard on those maths. Just have a look at that ratio sheet when you get a few minutes before we meet next week, and try and see, you know, what's happening with this business. As a financial planner, we've extracted these figures. What do these figures tell us? You know, are things getting better? Or are they getting worse? You know, what's going on with this business? Everybody okay with that?
Yes.
Okay, excellent. So see you again next week, and we'll interpret the business, and then we'll move into looking at the cash flow in more depth on the business. And then, having done all of this massive amount of homework, we then decide, well, what would we be saying to the client, yeah? Because that's what this program's about, isn't it? You know, being a financial planner, discussing with the client. Okay, so have a good afternoon. This is a pretty good day, touch wood. Thanks to Miguel for setting stuff up, and I'll see you again next week, okay?
Okay.
Okay, bye for now, enjoy your weekend. Bye then.
I know, right? Come here, I'm bless you.
No, I'm using it actually.
This is all chicken.
Do you better?
Show me that. Yeah. Show me that. Show me that. It's right there. And the ESPN. Yeah. Show me that. Yeah. Show me that. And the BSN. Yeah. Show me that. That's what. That's very good. And no website. She told me. Because it's so right, that job right. Yeah. And I don't feel like when you come to me, you can come straight.
Bigger than ice, yeah.
Need to go.
You saying what? You walk in.
But I've been thinking yesterday, man. My daughter's birthday
I
yesterday.
know, right?
So I've been on the sun and I had a crab in the dash and
Gotta be backed up, man. Gotta be backed up.
Yes, sir.
Yeah.
What's going on, though?
Yeah.
You going all over. You gotta come here first.
Everything is the same, right?
I even going to bed already, you know, you talking. I going to bed with the headache. You still got the same headache.
You take no pills.
I don't take no medicine pills, but let me take one of these one with my wife. I'll eat chicken.
Yeah, go 2 o'clock.
Huh?
Last weekend, go 2 o'clock. You? Don't expect fully no door to go. Much less left here 4, 5 plate. 2 more left to go. 8 soda. Right, give me a little nudge. When you working out?
Blue steak.
Oh, sure. Use the right person. I need to give this to him. Right here. Right person.
Listen.
Go outside this morning.
I don't know, they don't tell us already.
That's the boat of the other one. That just brown will just come out. Like this finished the one. We're gonna stay with blue.
Mommy.
What company should have blue?
We're just sitting in the bathroom, right on Mount Rock. Right on Cumberland Street.
Call. Let's calculate what we just said.
Okay. My neck, I can get. I can't get off like that.
Yeah, you will go back to bike. Everybody trying to get over bike in there.
I just supposed to
You're trying to go back.
like, let's go for a time. I'm gonna do one of 2 things.
Check y'all later.
Yeah, bro.
See the extra one there, Phil?
Yeah, man.
No, you know that journey.
You know. Don't let you see these go to waste.
Oh, you covered it up.
Go to waste like that, man. I didn't carry one. I ain't do too bad.
Sometimes it's sort of for the road.
You know that. it was true. I paid over $4,000. Laughing. Right.
I'm not
Shit,
really
I even know. I still didn't know I paid for this class.
You do?
And you want me to take it back?
Well, anyway, you can get it done. You get 6 more months, 5 more months. Don't do it, stop.
Shit, my daughter's get food today. Getting my Grammy now to get to them.
All right.
See you later.
Bye.
What? Yeah, it's the whole family. Santa Claus.
Go school, boy. Yeah.
So $20 I save, I put that towards this class.
I'm getting a job.
Later.
Bye.
Thompson.
What's happening?
Girl. Moving on, you met.
Maybe that's why you don't that's how it feels like. But I usually yeah.
I thought it was me. That was hot.
It's like 90 something degrees. It is. It's hot up there. And it is like
It is
degrees.
hot there. While we think, this is module 5. Let's take one, pass it down. Staples. For those of who you weren't here last week, right? Okay. These are the cases for module 4. So, you take this module 4.
That's the duty of care cases?
Yeah.
Okay, you sent it by email?
Yeah, I think I did.
Okay.
Yeah. You were, yeah, I didn't,
Yeah.
but anyway, yeah.
Thank you.
You didn't have to print them off.
Oh,
'cause
okay.
I know paper, ink, everything is funny these days.
He doesn't have a copy of
Another copy, I am noticing right now. You have the module 4, though? Employee,
I do.
the actual, okay. I don't think so, but I'll have to email it to you. Just send me a letter to remind me because I get older. I really try to keep up, but I have to write everything down now. Wow. Yes, I need to say, don't have to be anything wrong. All right. You said module 3?
Yes.
Yeah, I have it. Sorry.
Thank you.
God, it's good. Okay, there it is. Anyone else need module 3? All these things in the middle.
One number two as well.
So that gives you a PowerPoint for the day. These guys. For which we hope to get to today, we have to finish 1, 2, 3. So it's like behind, pick up speed. And the last handout is an article in the Guardian. Yeah, right. On, they're having discussions on whether to increase the minimum wage.
That's the discussion.
But they haven't done that yet. Remember, they can't do it until they, right. So it's just in consultation stage, but we won't be discussing this until, and by that time, it probably would have advanced, until talk about, I think, modern issues in employment law. Sorry? Oh, sure. Okay. 4 and 5? Okay. 4. She needs the UK cases too, right? 1, 2, 4.
How many UK cases were discussed and how did they have some cases?
Oh, yeah, what, I think what may have happened, I think it's only 3, you know.
Only 3?
Yeah, I think you probably took 2
Okay.
because they're so thin.
Right.
Yeah, yeah.
Just making sure.
Yeah. That's it, yeah. And she needs the, you got the PowerPoint?
Right.
Okay, and you need 5 now. Okay. There are no UK cases for 5. So. And we got the article, right? Good stuff.
Good afternoon.
Right. Good day. These are all the notes. Yeah, this is actually the handout for next week. This is the PowerPoint that we're going to cover today. See article. We did the contract, employment contract. We haven't finished though. Yeah, so you. And yeah, this is it. Yeah. Okay. No way. Okay. But you know, we filmed the process, so yeah. Okay. But it should be interesting though. This is your first time? Okay. Oh, that's why you shaking it. Yeah.
I work in all three territories.
Okay.
So this is now my skill to be there.
Wow.
So they just keep hoping that I'm here doing this.
just the PowerPoint for 3. So you could, I guess you could put it behind the actual function. Yeah, we did try to do it. Yeah. That's the and there's a good. We did the elements of a contract, but we're now going into the actual employment contract. And so I guess this one would go behind that. The content of module 4.
Oh, because it's missing altogether.
Yeah, because we're building as we go, right? Yeah. So the pieces that you put behind. Yeah. And you should be set. Okay. It's just an article on the page. You won't need that right now. Just you could read it. Okay, good afternoon, everyone. Those of you who've been away for 1 or 2 Saturdays and are back with us. Last week, we basically began talking about the meat of employment law, which is the employment law contract. And we went as far as the elements of a valid contract, offer, acceptance, consideration, capacity, and legal relations. And so you didn't miss too much because we just started to go into the actual employment contract and how those elements factor into the employment contract. Now, again, a bit of housekeeping. I would have sent you all of the pieces of legislation electronically, but they're now put on a link, which is bfs.edu.com. If you go on that website, bfs.edu.com. BIFS, right, sorry, -edu.com. I'll also email it to you. I always send you something on Saturday evenings. So if you don't get it down, I'll send it to you. And basically you go on the link for programs, and on the programs, employment law, and then you'll see another link for related documents. So we'll be uploading all of the legislation on there, all of the cases, and all of the reports I talked to you about are going to be there. Okay? So far, I think Miguel has only been able to put the legislation on there. So he's going to put the cases, UK cases and New Haven cases, and the reports I mentioned to you, all of those are going to be there. So hopefully you'll get that done by next week. Okay, so if you're traveling, that's good. You could just log on, go and have a read or whatever. Or if you have your iPad, whatever. Okay, so let's go to the part that we left off last week. We have a lot to cover today because I want to get to module 4 and finish module 4. Okay, so what I'm going to do is take some of the questions at the very end, unless you absolutely have to say something to stop me, okay, or if you just need clarification. And then remember to be reading your Bahamian cases, because if you've read them, you should start seeing some stuff fall into place based upon what we discussed already, or what we're going to discuss. And one of the cases went through the whole industrial relations and industrial tribunal type of procedure. That was originating summons and all of that stuff. Okay. So, I don't know if, yeah, that's gonna be difficult. You can see. Okay, yeah. Okay, so basically, the last week we talked about the employment contract, and we gave the definition of that contract, which we said it was a legally binding agreement between the employer and the employee, and it basically sets out the terms and conditions of the employment. Those terms and conditions being duties, responsibilities, the roles, and the like. And then we talked about the fact that the parties to the employment contract, that there are essentially two parties, the employer and the employee. And that any other party outside of that contract would be considered a third party, and that they would not have what we call privity of contract, meaning that they are not able to enforce that contract. Only the employer and the employee can enforce the contract against each other, no one else, okay? If you have a union representative, then that union representative is only acting on your behalf. They're not suing on your behalf, okay? Not suing in their capacity as the union, okay? And then we talked about, we had to distinguish one of the important elements in terms of the employer contract is to make the distinction between whether an individual is an employee or an independent contractor. And so we went through several considerations that you ought to look at to determine whether a person is an employee or an independent contractor. And these were some of the considerations that we looked at. Issues dealing with control and power, the ability, whether the individual was paying his own national insurance contributions, using the tools of trade of the employer or his own. This isn't an exhaustive list, but it's a list nonetheless that you can kind of have a framework to consider whether someone is an independent contractor or an employee, because that's very important to determine the type of contract that they have, whether it's a contract of employment, and from there, what can be enforceable in relation to that contract of employment. Okay, so we went through all of that. And like any contract, we said that in order for an employer-employee contract to be valid, it has to have all of the elements of a valid contract. And that means it has to have an offer of employment. There must be an acceptance of that offer of employment. There has to be some consideration given. There has to be an intention to create legal relations, which is normally presumed when you have a contract of employment. The parties have to have the relevant capacity, particularly the employer, to be able to engage someone under an employment contract. And there has to be certainty of terms. In other words, the terms of that contract must be certain and unambiguous. We then talked about the fact that the offer of employment must not only be clear and unequivocal in and of itself, and demonstrate a clear intention by the employer, but it must also be communicated to the individual to whom it's being made by the employer. Okay? So just like an offer generally has to be communicated to the offeree, so as an offer of employment have to be communicated to the employee. And basically we said that there should be no ambiguity or confusion as to the offer being made to the individual, although specific terms of the offer may be detailed in the employment contract. Okay, so you don't have to essentially tell the person everything, but the offer itself has to be very clear to that particular employee. In other words, they can't be still left in the dark or in some doubt as to whether they have an offer or not. Okay? Like an offer, the acceptance of an offer must be very clear or expressly accepted by the potential employee, either orally communicating the acceptance to the employer or his or her authorized agent, or by formally signing the contract of employment, which is normally how it's done. It may be impliedly or indirectly accepted by conduct, in other words, arriving to work and working on the job. Sometimes you have situations where you make the offer, you give them the contract of employment, they didn't sign it, but Monday morning they're on the job and they weekend. By that conduct, then it could apply, there's an implication in law that they've accepted the contract, although best practice is that you get them to sign that contract of employment. Does everybody understand? Okay, so it could be an implied acceptance or an express acceptance. You want to get more so the express acceptance in the signature on the contract of employment, but there is the option, or there is the other avenue that they can impliedly agree by simply by their conduct. Okay. So, following the principles of contract law regarding acceptance, in addition to the foregoing legal requirements, the acceptance of an offer of employment may only take place while the offer is still open. Everybody understand that, right? So if I tell you you only have until the end of June to give me your acceptance of this offer of this employment, you come July 1st. And it's already closed and I offer it to somebody else, then that's a no-go.
So you can